Hi, this is Paul Sankey with the morning call that we're doing every Monday. The big issue this morning, as opposed to just yesterday, but in many ways when I wrote the Sunday Sankey, is the situation in Shanghai, where the Chinese are going into an even greater shutdown situation, which is just a huge economy. The question is, what on earth are they doing, given that a country like UK has all but given up on COVID restrictions? I think there's three theories. The first is the worst and most sinister, which is that China knows something about a new COVID variation that we don't. That's the sort of nuclear option, and we'll put that to one side as unlikely. The second one is that they're in cahoots with Russia and trying to wage economic warfare on the West. Now, I think they were in cahoots with Russia until the Ukraine invasion turned into a complete military and Russian disaster. And China at that point sort of did a Homer Simpson back into the hedge. They haven't really opposed Russia, but they're hardly supporting them either at this stage. And the third theory is that they're trying to take the heat out of commodity markets, which I think is the best theory, which is, if you think about China, it's an intermediate economy in many ways, both in terms of GDP per capita, but also in terms of what they do. Huge importers of primary commodities, primary raw materials, huge exporters of intermediate and finished manufactured products. Really, this is a worst case scenario for them, in a huge year for them with the upcoming party congress, which will also, in theory, decide the future of Xi, the premier. What they're trying to do is take the heat out of what could be a terrible situation for them, with massively high primary costs and weakening Western consumers of both intermediate and finished products. China could be really screwed here, and so what they're doing is taking a radical attempt to take all the heat out of markets. Now, what that would include, obviously, oil, and it's certainly not working for natural gas at the moment. So it's certainly not in terms of LNG. But also interesting this morning that, notwithstanding the Shanghai news, the oil price is going up. And that's very bullish, because obviously the shutdown in Shanghai is very bearish for oil prices. So what's going on there, we don't know, but it's definitely a big news flow item to keep an eye on as we go into Q2. The second thing is the ongoing situation in Russia, obviously, with more talk of even greater sanctions against Russia because of the genocide situation that's being revealed there as Russia withdraws from the Kiev area. In the note on Sunday yesterday, we talked about the fact that it looks like we'll sort of continue as you were, with the Europeans refusing to pay Russia in rubles, but now Europe's talking about complete sanctions on Russian gas, which they can maybe pull off into summer. We'll see. There's a lot of noise here, but again, it's a situation that has to be watched. And they're certainly stepping up the rhetoric on trying to get off Russian gas altogether because of this incremental negative news, which obviously is the genocide type behavior that's going on. So it looks like as we go into summer, we're really going to make a concerted effort, and as time rolls on, an even greater concerted effort, just to reduce Russian oil and gas from the market altogether. And if Putin survives, which most people think he will, although I tend to think it's more likely that he goes than most, I don't think it's likely, but I think I've got a higher likelihood than others that Putin actually just goes because of this absolutely disastrous situation. I've said if he was a CEO, he'd be fired. I think that if Putin stays in power, then we've lost significant, obviously, ongoing volumes of Russian oil and gas, and that becomes very bullish, ultimately, for the US E&Ps, who will go into a very good Q1 earnings over the course of the next few weeks. Notwithstanding those who have bad hedging. We had an announcement from Synovus this morning that they've lost around $1 billion on hedging. But what's happening over time is that hedges are being rolled off, as we always wanted these companies to take away hedging and expose their business model to the market fully. And as that happens, it will tend to bring up the back end of the curve, which will tend to drive the oil stocks higher. So we remain very bullish on oil stocks, notwithstanding the incredible noise that we're getting from China and all the rest of it. If we quickly look here at a screen share, what you'll see here is hedging. This is from the Sunday Sankey. This is much less hedging than you've seen historically, with some negatives such as Oasis, Laredo, CRC up here, and some somewhat negative but better, which is this Pioneer, which is actually de-hedged, but it'll cost them 300 million on the quarter, and others that are just fairly consistent with what they said they would do, which is only about 25% hedged. In the case of Devon at a bad price, in the case of Marathon at a very good price. The potential for earnings strength is going to manifest itself in this chart, which is As we see earnings upgrades roll through in Q2 and beyond, this line, which is oil share of the S&P 500 earnings, will keep going above the 5% and onwards, especially as you get downgrades across the wider market in other areas, such as Apple shutting down in Shanghai or Tesla shutting down in Shanghai. And then at the same time, you'll see pressure on this line, which remains still very muted, but just hitting 4% of oil's actual share of the S&P 500. So that's some quick stuff for you, and I'll leave it there in order to keep it relatively short. Have a great week.